Hi, welcome back to my channel. I'm Sarah Jane and I talk about my financial journey. The inspiration for today's video came from a conversation that I was having with a friend this week. We were catching up, we hadn't spoken for a while, and I told her that I'd launched this YouTube channel, was sort of expressing my dismay at not starting investing earlier. I wish it was something that was taught more fully in schools and that our parents knew, so to be able to pass it on to us. And, you know, was encouraging her to get involved, to have a look into it. And she was really reluctant. There was a real lack of understanding and unwillingness to take that plunge. So what I thought I would do is just prepare a video that I could send to someone in those circumstances, or for any of you that are worried or concerned about taking that plunge, that just sets out in real basic terms the power of investing and why it's so important that we are all armed with that knowledge so that we can take our own decisions about what we do with our money, with our savings, and be in a position to make it work for us as much as possible. So in preparation for this, I asked a couple of friends and family members about some of their concerns or their perspectives on investments and why they weren't doing it already if they weren't, and what puts them off from starting. The main themes were really not having enough money, sort of extra, to be able to invest it. Concerns that it was really complicated, they didn't have a clue how to get started, they didn't know anything about the stock market or businesses, and felt that they were complete beginners and wouldn't have a clue where to start. There was concern that the fees would be too high and that would take up most of your profit, that you'd have to pay tax on it anyway, so what was the point? And I think the biggest concern really that it was way too risky. Why would you risk putting your money into investments when you need it and you don't have that much spare cash anyway? So it's not something that they were willing to get involved in. It was really perceived to be something for rich people that had lots of extra money lying around that they could afford to lose it all. So those are some of the key things. So in this video, I'm hoping to address some of those concerns, give some information about investing, and you know, the main aim is to encourage people to start. I certainly wish that I'd started many years ago, and I hope that this video encourages you to start too. So we've spoken about some of the concerns that people have, but what are the benefits of investing? Putting your money into an investment, whether that is into stocks and shares, whether that's bonds, property, commodities like gold, silver, or something else, it's an opportunity to make your money work for you, so to grow, to increase in value, usually over a long period of time, and it's an opportunity to really build wealth. Implementing that opportunity means that the size of your portfolio should grow over the long term, and due to the power of compound interest, the longer that you're able to invest, so the earlier you start, the better, because that gives the potential for more return. I'll deal with that in a little bit more detail shortly, but really compound interest is the real powerful factor in terms of investing. Investing is also a way to generate passive income. Usually stock markets will go up, so the value of your investments will go up, and you'll also have the opportunity for dividends. A company pays part of its profits back to its shareholders as a dividend, and you can then reinvest those dividends into your portfolio and compound that growth as well. So, you know, you can earn money without lifting a finger. It's a way of generating tax-free profits. Because of the operation of the Stocks and Shares ISA, we have each tax year up to £20,000 that we can invest, and any profits or growth generated from that is completely tax-free. And finally, one of the big reasons you should invest is to try and outperform inflation. Inflation is a general increase in prices in an economy accompanied by a decrease in the purchasing of money. So basically this is the rise in cost of living. So I did a quick Google, and if you look at the price of bread over the last 100 years, I think it's increased by 11,000% or something like that. You applied the same rate of inflation, I think by 2115, a loaf of bread will cost £115. So the way that it works, the government uses different indexes, but essentially there's a basket of goods and services, and it tracks the different price of that, which works out the rate of inflation. But in simple terms, £1,000 sat in your current account today will not be able to purchase the same amount in goods and services as £1,000 will do in 20, 30 years' time. So by having your cash sat in a current account, which at the moment the interest rates are so low that it's barely increasing at all, it's actually in real terms going down in its value due to the impact of inflation. Therefore, using investments is a way to counteract that, because you're hoping that your portfolio will grow and therefore outperform inflation. I think that if you're not necessarily used to financial terms, it can be quite difficult to get your head around that. I think that we're taught, and in this country especially, the power of savings, don't get into debt, but just having something sat in a current account is not necessarily the best way to be using your money. So the rest of the video, I'm just going to respond to some of those initial queries. So some of those key themes were, I don't know what I'm doing, I don't know where to start, and it's too risky. And I think most of those concerns can be addressed with the concept of index funds. Is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. So it's basically a way of having a little share in each of the companies across a particular index or market. And there's a variety of different funds available, and I know that's where it can become a little bit more complicated, but for the purposes of now, if you just have in your head that it's a little bit of lots of different companies, and therefore it's a great way of having a diversified portfolio, and it can be from different geographical locations across a spectrum of different sections of the market, so sort of technology. They're great for beginners because you don't have to choose or research a particular stock, so there's no time investment in terms of researching what's going on, reading financial statements. You just choose a particular fund. So the S&P 500, for example, that fund would track all the top American companies, so you'd be buying a share of each of them. You don't need to go and look into Apple or Google or any of the other companies, what they're doing. You're just buying the whole lot. So you're getting access to that diverse portfolio, so that's seen as less risky, there's less time investment, and it's easier to ride the waves of the market going up and down. There's no denying that the stock market is volatile, it can go up, it can go down, but by buying an index fund, you're impacted by what's broadly happening across the market. So this week in particular, a lot of the technology stocks are seeing a real big drop, sort of 30% in some instances, but that's not happening across the whole of the market. Yes, the index has dropped, but not by 30%, so you're less exposed to the bigger impacts in the market. On the flip side, you're not then exposed to any huge gains, but I think that's a good offset, particularly for a beginner. So if we have that in mind, and using index funds as an example when I'm talking about investments in these circumstances, it becomes a lot more straightforward. Yes, you do have to pick the fund, but it's not like researching into particular stocks. So in terms of where to start, I recommend opening a stocks and shares ISA account. I've chosen Vanguard. I'll link the video there going step by step exactly how you do that, and also a video covering all of the basics of that particular platform. But that's all it is. It took me less than 10 minutes. You can open a stocks and shares ISA, pick a fund and start investing. If you're able to do that, that addresses a lot of those concerns. You don't know where to start, well, open a Vanguard account, choose a fund. You don't need any expertise in the stock market to be able to do that. I would recommend the Life Strategy Fund as a way to start. One of the other concerns was about the fees and the taxman taking all of the profits. Again, using Vanguard as a great example, they're renowned for low cost fees. There is a portfolio fee of 0.15% annually, and then fund specific fees, but they vary between about 0.1 and 0.6%. So something to be mindful of, but in the grand scheme of things, not huge fees by any means. And you can start your Vanguard account with £100 and doing that on a monthly basis, or a £500 lump sum, and then there's no commitment then. You can sort of add as and when you like, but the opportunity is there to start a direct debit, and you can add as little and as much as you like up to the threshold for your ISA. But you know, you can automate your investments then. You can put it into your index fund and then forget about it. You don't need to monitor it. You don't need to keep swapping and changing if you don't want to. You can set up your direct debit and leave it. And you know, if you are using the stocks and shares ISA, you've got £20,000 per tax year that you can invest, and that will be in an ISA wrapper, which means the taxman can't attack any of these growth or dividends or profits that you make. They're completely tax free. So again, you've got low costs in terms of the fund or management fees. You've got a low point of entry at £100, and you have got no tax to pay if you're using the ISA and within that limit. There's also, if you want even less costs, trading 212. There's a wait list for that at the moment, and it's a slightly different aspect but worth exploring as an alternative, and they've got really low fees as well. One of the other concerns of my friend was being able to access her money freely, and sort of saying, well, what if next year that I need access to the money, can I get it out? And it can be quite a complicated response to this, because the short answer is yes, you can. You would have to sell your investments in Vanguard and then request the funds to be returned to you, which would clear, I think, after a couple of business days. But really, investing like this is for the long term, and it's a long-term philosophy to realise those long-term gains. And I think really in that aspect, you need to be thinking about your financial goals and your reasons for investing. It might be that it's in readiness for your retirement, in which case, depending on your age, you don't want to access those for 10, 20, 30 years. Or you could be saving for a house and using your investments that way. You know, you have to think about why you're doing it, and that's a really good boost in terms of forcing you to do it each month and mind your spending and your budget so that you can be in a position to put some funds into a separate account. But then also thinking, well, I won't need to access that money in 1 year, 2 year, 5 years time, because my long-term goal is it's for retirement, and that's when I'm going to access it. Yes, there is the freedom compared to sort of a pension where you will have extortionate fees if you want to get it out before 55, I think soon to be 58. So there is the flexibility there compared with investing into a pension fund. You know, if you're going to be putting your money into investments, try and leave it as long as possible. If you're concerned about particular funds that you need to access short term, have those in an easy access saving account, or build up your emergency fund as well. Yes, you can access it, but try not to if you can help it. It's not really the purpose of these investments. Another of the queries was, I want to be able to work out what's going on, but at the same time, I don't want to be too heavily involved. I think I've already touched on this in that choosing an index fund, you're not looking into individual stocks and shares. It will track the index, so that's quite hands-off. If you are able to automate your investments, you don't need to look at it, because again, it's long term. There's going to be peaks and troughs. You shouldn't be concerned about those in the meantime, but you have got the opportunity to have a look if you want to. On Vanguard, it will show you a particular fund's performance, its loss or gain, as well as your overall portfolio and the amount left of your ISA allowance. So the information is there if you want to use it, but again, you can have a hands-off approach if you want to as well. So I hope that's addressed some of those concerns and explained how easy it is to start investing, that you don't need a lot of money or particular expertise. But I think the real powerful thing, and what will really hit home to a lot of people, is the power of compound interest and starting to invest early. Now, compound interest can look quite complicated. I'll put on the formula for calculating it. So I think it's probably best exemplified through some examples, because that really then, I think that's easy to get your head around. If you compare two individuals, the first one, called Tom, starts investing when he's 25 and invests £5,000 per year for 10 years. And then after the 10 years, stops investing completely, but leaves it sitting in his portfolio, and then retires at 65 and withdraws the investment. Then you have James, who starts investing when he's 35, and he does that continuously until he retires at 65. So at the same rate, so £5,000. So he invests £5,000 per year for 30 years until retirement. So you have Tom, who has invested money annually for 10 years, and James, who's invested money annually for 30 years. But Tom's investment has been left sitting there for a much longer period. And then when you compare the figures, it's pretty startling, actually. I think this is based on about a 7% return. Tom's portfolio, when he retires, would be around £787,000, whereas James's portfolio would be worth around 611,000. So that just demonstrates how powerful it can be investing early, and even if you end those investments, that just having it sitting there and the compound growth and year-on-year return will just really increase the value of those investments. So yeah, the message there is start as early as you can. If you started with £1,000 and then decided to invest £250 per month over a period, what would that look like? I'm using a 7% rate of return, which is about the average that the stock market will return, factoring in inflation. I think the S&P 500 averages return has been about 10%, but using 7% to take account inflation, although that's not guaranteed, but for the purposes of the example. So £1,000 at £250 per month after a period of 25 years would be worth £202,000. So you would have contributed £76,000 and the growth would have been just over £126,000. So significant amount of return compared to your investments just by leaving it for that length of time. If you reduce that to 10 years, so the same amount of initial deposit and monthly deposits contributed £31,000 and the portfolio would be worth just under £45,000. So a return of just under £14,000. So a lot less because you've invested for a shorter amount of time, but it's still much better than, in my opinion, than letting it sit in a current account, attracting no interest whatsoever. Now, you might be saying, well, yeah, that's all depends on whether you actually get a 7% return, and that's not guaranteed because the stock market's really risky. And to a certain degree, that is true. Investing on the stock market is a risk. Returns are not guaranteed. However, based on historical performance, which I accept is not absolute guarantee of future performance, but if you're looking at what's happened in the past, the stock market has consistently gone up. Yes, there's been crashes. Yes, it goes down certain weeks or months, but overall, if you're keeping it there long term, and that's the key, you can keep adding to it monthly, yearly, you're going to ride out those waves and it'll continue, and it should continue to go up. As of preparing for this video, I was doing some research and somebody much cleverer than I am managed to look at an algorithm of the performance of the S&P 500, and what they looked at is if you invested $250 into the S&P 500 and left it there for 40 years, what would happen? What would be the average return? And it came out at about $1.2 million. And there were some differences between that. The worst performance would be if you started in 1969 and then your 40 years ended in 2008, which would have been mid-financial crisis. So your $120,000 contributions over that period would have been worth the $1.2 million. The best performance period would have been ending in 1999 at the height of the dot-com bubble, and then those contributions of $120,000 would have been worth around $3.5 million. But what that sort of algorithm found was that if you invested the $250 a month and left it for 40 years, no matter where along that period, you would have averaged out a valuation at the end of that period of 1.2 million. You know, there is some degree of risk. Yes, you have to accept that. But historically, and given the nature of the market, it's more than likely that your investments will go up. It's where so many rich people do it. Why can't you? So I think that concludes the video, really. The message I wanted to get across was really the power of compound interest, the importance of starting early, but starting is the main thing, and that it doesn't have to be overly complicated or expensive. If you use an index fund and a low-cost platform like Vanguard, you can start with a small amount of buy-in and you can set it to automate and you can leave it there for 30, 40 years and not have to worry. And it can be tax-free if you're within your ISA allowance. So I hope that was helpful. If you've got any other questions or concerns that I may have not addressed, or you've got since watching this video, please let me know in the comments below. If it's inspired you to start investing, then let me know as well. Look out for my next video, which will be me going through choosing my Vanguard funds and potentially a trading 212 portfolio update. But yeah, really grateful for watching. Thank you.